On today's Hashi, I'm discussing housing inventory for the week, Friday's jobs report, and Fannie Mae home price expectations. Today is Monday, September 9th, 2024. I am Byron Lazine, and the hot sheet starts now. Good morning. Welcome back into another week here on the hot sheet. It's the only live show on the internet with a 24-hour look back on housing. If you're getting value from the hot sheet and everything we do at BAM, hit the thumbs up down below and subscribe here to the YouTube channel. Also, we are almost a month out, just over a month out from BAM Mania in Las Vegas. If you haven't secured your spot yet, do so immediately. If you've been thinking about it, go to bammania.com. Do not wait, as these opportunities are going to be closing out very shortly. VIP is set to sell out first, then general admission will sell out next. bammania.com to secure your ticket, your seat at the event of the year, October 17th and 18th at Circle Las Vegas. This is basically a brand new venue with a real estate event that you've never seen before. bammania.com to lock in and join us in Las Vegas. All right, let's lock in to inventory and where we're at. We were hopeful that we'd see a September that bucked the trend of most Septembers, and we would see inventory continue its trend upward that we've seen throughout the year. That would have been amazing, but that is just not simply going to happen as it appears from the start of September. Inventory, just like last week, fell slightly. This week from 704,000 plus to 703,600 plus. This is according to data from Altos Research. The same week last year, inventory slightly rose. We're talking hundreds, from 509,500 plus to 509,800 plus. Okay. We're still at basically our peak for the year of 704,700. We're at 1,000 less than that. So we're starting to flatten out, as you see here, as we've seen even earlier in the summer in years past. If we go back to 2019, a really normal market in comparison to what we've seen as of late, you can go into July in 2019 and see 969,000 on active listings. That 969 or 965 range stays basically consistent all the way into September at 962, 963, at 957 at the end of September. So really July, August, September in 2019 were flat. We didn't start flattening out this year until the end of August. And it looks like we're now on that flattening side of the curve before we get that seasonal fall in inventory. Seasonal meaning not only is it the fall season, the end of the fall, but that decline in active inventory. That active inventory could come much sooner this year than we've even seen in normal years, as on November 5th, the election will loom. In October, that's all you will hear about. Active inventory right now is 38% more than last year. So we are finally in a much healthier place than we've been in some time when it comes to active inventory. One of the things that can boost active inventory the most is new listings coming on the market. Sellers saying, oh, I'm comfortable with where the 30-year fixed is, which, by the way, it's at its lowest level in almost a year and a half. We'll get to that a little bit later. But new listings can really drive more inventory. New listings could drive buyers off the sidelines. If you see really nothing ever available, you don't get motivated to buy. If the iPhone is the same every single year, it's why over 300,000 people haven't updated in multiple years on their iPhone. 300,000 iPhone carriers are just saying, I haven't updated in 4 years. Apple's hoping today, when they launch their new iPhone 16, that changes, that they have enough differences in the product to move some of those iPhone holders. And I think that 300, Bobby can check me on that. That might be 3 million, that number that I saw this morning. It's a large number of people who haven't upgraded in 4 years. Point is, if buyers, home buyers, never see anything new about the market, they kind of quit on it. They just stay with what they got. They don't upgrade from the apartment for multiple years. They just get comfortable. So until we start to see new listings, not only do we not see inventory go up, we actually don't get a lot of those buyers off the sidelines. We don't get them motivated about, ooh, look at that. Oh, but there's another option. I want to get back out there and look at all of these options. New listings for this week was an improvement. It was an improvement over the same week versus the last 2 years. This is actually maybe one of the most positive new listing weeks we've seen in some time. 61,500 plus, still well off of obviously the peaks of 17, 18, 19 when we were looking at these numbers, or during the recovery years of 12, 13, 14, 15 for sure. 61,500 for this week on new listings. Only 49,000 plus last year, 58,000 in 2022. So beating the mark of the last 2 years. Of course, those marks aren't hard to beat. Okay. Those marks are some of the lowest in 2023 in particular was the lowest new listing data ever recorded. Okay. What was the number here? Okay, so 270 million. So I'm talking 300,000, 3 million. I'm completely off. Okay, I might have seen, I don't know what I saw, but anyways, thank you for fact checking me, Bobby. 270 million iPhone users. Wow, what a number. Haven't upgraded in 4 years. Why? Because this thing doesn't ever change. It just stays the same. Okay, it doesn't do anything. You get a little bit better camera. I mean, really, the look of it hasn't changed. Okay, so if it doesn't change, people sit on the sidelines. 270 million iPhone users sitting on the sidelines and not upgrading. They don't have a reason to. iPhone's got their event today. We'll see if they have an enticing change or a tweak to the iPhone that gets some of those users off the sidelines. Okay, price reductions that are happening right now, currently at 39.8%, so nearing back up to 40. We had a little dip last week, now back up. Obviously, the 2022 trend line is the one that happened right after the rates went up, got as high as 43%. We're already over last year's peak on price reductions. And you expect this number to go up. It typically does as you get towards the end of the year and sellers get antsy about getting the deal done. Typically in a normal market, you see about a third, and those are the numbers here for same week last year. We were at 40, or for 22, sorry, 40.1%. Same week last year, 36%. So we're above last year's number on price reductions. Pending sales, okay, pending sales still very low in comparison to a normal market and well below 2022's levels. Come in for the week at 358,000. That is 3% more than last year at 348,000. But we are riding essentially the same trend line that we did last year. These are two really low years for pending sales, pending contracts in escrow, whatever you refer to that as in your market. 390,000 was the mark in 2022. This is the real estate recession. It's not home prices. It's not values. It's not equity. It's the amount of contracts that are taking place. This has a ripple effect on a lot of categories in the industry and a lot of supporting roles in the industry as well. Okay. All right. Let's take another look one look at one other point here of the report here for Monday. And that is, what would it take, as we saw the rates, the 30-year fix get to as low as 6.25 at the end of last week. 6.27 actually on Mortgage News Daily was the read on Friday. The weekly came in at 6.35, matching the week before. This is the lowest level, by the way, since we saw in April for a day, basically. In April of 2023, for one day, we saw 6.16. Before that, you'd have to go back to February 2nd of 2023 when we touched down at 5.99. There's only 2 days in the last year and a half, essentially, year and a half plus, that you saw lower rates for on the Mortgage News Daily Read? February the 2nd and April 16th, both of 2023. Okay. We're at 6.27. That means there are lenders in your local market right now that are locking buyers in, particular buyers and particular lenders, obviously, depending on their financial situation, locking people in at 5.9, locking buyers in at maybe 5.875 right now. Maybe you saw this over the weekend. Maybe you were able to lock one of your buyers in Friday afternoon as an active agent into a under 6% mortgage rate. So you could go shopping over the weekend with that rate in hand. But what's it going to take to really get that number to be under 6% for all buyers? Remember, not every buyer can qualify or pay down the rate to get under 6%. When is the prevailing rate going to sit at 5.75, which means some buyers will get in the low fives? When will that happen? And more importantly, what would it take for that to happen? Okay. Here's what it would take. Number one, the economic data needs to weaken, especially the labor market, to get down to the 5.75 range. We need two things. Okay. The first one is the economic data must weaken, and the labor market would need to weaken even more to drive down closer to that number. One of the reasons we're seeing the 30-year fix, move down, obviously we know the Fed's going to cut. That's already built in. But the spread between the 10-year and the 30-year is improving, okay? But for the 10-year to get low enough to match 5.75 at the current spread, we need a weakened economy. We need a weakened job market, even more uncertain than we've seen in recent months. I think that's important to know because it's important to articulate to buyers. If you have a buyer that say, I'm going to wait for the 30-year to go down to X, okay, well, tell me more about that. What makes you say that? Are you certain that we're going to be in a good economic situation if we get there in a hurry? I know you want to buy by next spring, okay? Helping them understand that people lose jobs if we go down to 5.75 in the short term, that the economy weakens if we get down to 5.75 in the short term, meaning before the end of this year. Could happen next year, just based on time and the direction that we're heading. Do they want to wait 12 months? If they do, more power to them. Not everybody does. What do you understand and what certainty do you have about what happens economically and in the job market if we're waiting for 5.75 to be the prevailing rate so that you can buy it down to 5.25? Helping them understand that helps them understand that this winter might be the buying opportunity. While the rates are gradually going lower, there's a lot of buyers still sitting on the sidelines, still waiting for some shoe to drop that may never drop. And they might even be waiting and rooting for an economy to collapse. That seems odd. Why wouldn't you go and negotiate with the sellers who are on the market? 40% of them are thinking about or enacting a price reduction right now and trying to get the best deal possible. I think we can all agree the spring is going to bring more competition. It's easy to get a buyer to see that. The second thing that could actually bring the 30-year fix down would be a stock market correction. Okay. Right now, that could trigger a flight to safety, meaning that money can go into bonds if you had a stock market correction. If people sell stocks because they believe that the stock market is about to get hit due to a recession, if there's more sellers than buyers in the stock market, prices on these equities come down, obviously. Flight to safety, meaning they go to bonds. And if that happens, you will see that number come down, okay? The bond market has shown the ability to break below the bottom line of 3.8%, as 3 of 4 jobs reports last week were negative. However, we'll need to see more economic weakness for that to continue, okay? For the 10-year to continue to move down below 3.8, okay? Now, I don't think either of those two things that what is being presented there as ways we can get, a half a point off of the 30-year fixed by the end of this year. Neither of those two options sound great to me. People losing job, weak economy, or the stock market tanking, and maybe tanking is strong, but having a correction. Baby boomers and retirees hate correction. They hate 10% corrections. It shutters their world because 10%, does that mean another 10% is coming? Does that mean we're warming up to a 20% reduction? Nobody likes those reductions. Okay. That is something that I think a lot of people are afraid of right now as we gear up into these uncertain couple of months. If we continue to see a job market weakening, you could see more fears around that. But for a home buyer who's just trying to buy a home, like, are we waiting for one of those two things to happen? In fact, are we rooting for it? Because that's what it would take to get the 30-year to where you're saying you want it, as opposed to maybe taking this opportunity to the lowest level in a year and a half, the highest level of inventory in much more time than that, and sellers who are getting to the end of the year when you always see the best deals in every single market. Let's go negotiate from a position of strength as opposed to the spring when we're not going to have that to our advantage. Okay, we had a jobs report on Friday. And the non-farm payroll report, according to the Bureau of Labor Statistics, came in at 142,000. So payroll employment increased by 142,000 in August. The unemployment rate changed little at 4.2%, actually came down from 4.3 to 4.2. That 142,000, though, was a miss. Okay. That number was supposed to come in at 161,000. So employment comes in lower than expectations. Remember, we've missed all year on that number. In fact, we missed so much they had to revise it just a few weeks ago and said that we, even with our downward revisions, like this is a downward revision or this is a miss. We could have a downward revision next month on this number. And then we could look back in 6 months and see a further downward revision. That's what we just saw a few weeks ago when we missed jobs by over 800,000. The true number was closer to 1.2 million because of the downward revisions. So jobs hiring continuing to miss the mark on where on where these numbers suggest that they should come in at. The unemployment rate now being stronger than what we saw last month, now at 4.2 versus 4.3. Unemployed people are at 7.1 million. That changed a little from August. These are higher than a year ago. Remember, we had the sharp incline happening on unemployment. So I like the 4.2 because this cools it off a little bit. I'm actually one of those people not rooting for job loss. I don't think that's helpful for the economy, even though you get a lower 30-year fix. I think we've seen much more significant damage when we go into recession. I guess you could argue that a recession is needed with all the money we've printed, but that's a whole nother category. So I'll take the 4.2 cooling off. Brings a little bit of stability. That was probably the best report we've seen out of as of late for jobs. Remember that steep incline enacted the SAM rule, which would suggest that we are heading towards a recession. So maybe this number can, subdue those fears just a little bit. If you want more on the deeper discussion around jobs, myself, Lisa Chinati, Tom Toole, we had that discussion on Friday. Friday's edition of Knowledge Brokers Podcast is out. You can go to @KnowledgeBrokersPod here on YouTube, separate channel, or wherever you listen to audio. If you're a listener of Knowledge Brokers Pod, love to let me know in the comments if you're even aware of that pod. We release that one every single Friday. We had a deeper discussion on jobs over there on Friday, so you can go check that out. All right. Let's go to Fannie Mae's report now. Fannie Mae's Home Price Expectation Survey, HPES. This is produced in a partnership with Pulsenomics, LLC. They poll over 100 housing experts across the industry and academia for forecasts of national home price percentage changes in each of the coming 5 calendar years with Fannie Mae Home Price Index as the benchmark. Okay. Here's the expectations. So here's some top line expectations. By the way, all the charts available for you inside of BAMX. So BAMX members, you get access to all of the hot sheet, the show notes that we have. These show notes, because of what we're dealing with on this episode here, week to week inventory and these Fannie Mae projections, these show notes every single Friday, or I mean, every single day. Sorry, I'm reading a comment at the same time. Every single day are delivered inside of BAMX. BAMX members can use these, copy and paste it in their email marketing and in their follow-up, all their communications with their sellers. Really robust show notes, as well as all of the charts are available to download each and every single day. If you're not in BAMX yet, use code HOT to get your 10% discount into BAMX. And BAMX members, for those thinking of BAM Mania, BAMX members, you get 25% off of ticket price on BAM Mania. So BAMX members, bammania.com, lock in. Okay, taking a look now at some of the top line numbers from these 100+ experts that Fannie Mae surveyed. The panelists' average annual home price growth expectations, 4.7 to end off the year, and then a deceleration on that appreciation next year at 3.1, and then 3.3 in 2026. So you see here that the expectations going all the way out to Q4 of 2028. You have a very optimistic quartile saying we're going to get 31.6% between now and 2028. The most pessimistic quartile looks like they actually have a drop in home prices in the short term before going up 7.5% total over the next 4 years. And then panel wide, you average that out 20.2% over the next 4 years. For the conversations, this chart right here, Bobby, make sure that this one in particular is inside of BAMX. I think this is, I think this one is really important. For any of those buyers who are waiting for prices to come down, who are just stuck on the sidelines sipping Gatorade, this one is very important to show. Even the most pessimistic housing experts have home prices increasing over the next 4 years, 7.5%, while most housing experts actually see anywhere from a 20+% gain to as high as 31% over the next 4 years. Now, nobody really knows what's going to happen over the next 4 years, but let's just take a look at what's happened over the last 40+ years. Okay. House prices have done nothing. This chart shows you the whole story. It shows you the future projections of the housing experts. And it shows you the last 40+ years that housing has done nothing but go up and to the right, has done nothing but go absolutely up, outside of a mortgage crisis to the likes that this country or any country has never seen in history and is far, far behind us. Okay, so really important chart there to help buyers hop on this winter season opportunity. Moving deeper into some of the reports here. Let's go into, and we did the price expectations on home values. Let's go to the home supply shortage, okay? There's been a growing trend at both state and local levels to implement zoning and permitting reforms to increase housing supply and boost funding for affordable housing construction. Listen, I think zoning changes are very hard. I mean, some of the things that I don't hear anybody talking about is like, what about just like creating some new city instead of changing zoning on existing cities? Well, what about some new cities? Could you involve the private sector to invest in some new cities? Could we reimagine how we build cities, right? Might be something to that. Which choice best reflects your view about the impact reforms implemented to date are likely to have on new construction of all home types coming in the year? So Insignificant positive impact is 41%. Moderate positive impact is 45%. So the experts are not very bullish on the reforms that have been presented that are going to boost affordable housing construction. Okay. In fact, almost all of them, only 3% have a significant positive impact with the reforms that have been presented on new construction affordable housing. Which choice best reflects your view concerning the marginal impact the added supply resulting from those reforms would likely have on home price growth? Not much change, 54%. Slow, moderately, 34%. All right. Really, when you look at any experts and you look at anybody with common sense, anything that's being presented now, anything that's presented by any politician between now and November is likely to have very little impact on the really systemic problem that housing has had over the last 12 years, which is lack of building affordable inventory. It goes back even deeper than 12 years when you put the word affordable in there. So we're not expecting inventory to come solve the problem of home prices being out of reach. Another important factor for buyers to understand, like you're not going to get, I don't care what politician tells you, they're going to somehow create X amount of homes out of thin air. That takes a long, long time for those plans to get implemented, if they ever get approved, which is very unlikely, and then to go change the zoning, find the land, buy the land, get the land ready, develop the land, get the units finished, sell the unit. And we're talking years if these plans ever came to fruition. And then printing money on the home buying side, we all know how that works. That boosts up the prices so somebody with cash can come in and beat that home buyer down anyways. And all it does is raise prices, and the investors sit back and say, ooh, that was nice for me because I own some real estate. All right, 3 potential and state and local housing policy reforms that you believe would have the greatest positive impact on the overall U.S. housing market. Okay. Hasten construction permitting process got the most. I would agree. Expand zoning for multifamily housing developments in transit. That's second most. Enable more missing middle or light touch density housing construction. Reduce building code restrictions. Yeah, like take some regulation off the builders if we want them to build more. That makes sense. Increase funding dedicated to new affordable housing. Cap minimum lot size requirements. Expand zoning for accessory dwellings. Relax parking space requirements for multifamily housing. That one, I don't like that one. Relax parking space requirements. Like, where eventually will people park? I mean, I guess if you're just going, I know to some degree, they just want this to be a rent everything world. And listen, I'm not a car guy by any means, but people like their cars. So, all right. Anything else in this? There's a lot in here. We'll link it up inside of BAMX so you have all of it. There's a lot of information. I don't think there's anything else I want to touch on. Those were the big ones there. Do like where the 10-year is at right now. 3.727 here to start the week. We'll see if we can get more movement downward on that. To stay below 3.8, as we read in the report, it's not the easiest thing in the world. Again, the 30-year fix ended at 6.27 last week. And right now we're 9 days, 4 hours away from the FOMC meeting. The Fed watch is on. And right now, 3 out of 4 chance, 75% that it's only a quarter point cut, 25% chance that it's a 50-point cut, half a point, and obviously 100% chance that they do cut per the CME group outlook, as well as per Jerome Powell's own words, essentially. Okay, there you go. There's your hot sheet kickoff for the week on this Monday. Hope everybody has a great start to the week. Reminder to lock in and get your tickets to BAM Mania. We are just over a month away. BAMmania.com to join us in Las Vegas. It's not just about what you'll be learning from the event, but it's who you will be in the room with. Go to BAMmania.com to lock in your seat as an agent of change. BAMmania.com, October 17th and 18th in Las Vegas at the newly designed, fresh Circa Las Vegas, where Stadium, Swim, as well as the Legacy Club, both of those venues we will be having events at. So BAMmania.com to lock in. I will see you guys all back here tomorrow on the Hot Sheet, 9:30 on the East, 6:30 on the West. Until then, toodaloo.